Welcome to The Explainer. So today we're going to tackle a topic that's been causing a massive headache for businesses all over India, and that's the goods and services tax on rent.
So many companies right now are either paying tax they don't need to, or even worse, they're risking some pretty big penalties. And it's all because the rules have gotten really complex, and they've just changed. Okay, you're going to want to circle these two dates on your calendar. Seriously. There was a big change in late 2024, and then another one hit in early 2025. And together, they've completely rewritten the rulebook. Getting this wrong? It could cost you. So let's make sure you know exactly what you need to do.
All right, let's jump right in. We're going to break this whole thing down into 5 simple sections. The goal? To take you from totally confused to crystal clear.
Okay, first things first. Before we dive into the deep end, we need to build our toolkit. To get through this, let's call it a maze. There are a few key ideas you absolutely have to get your head around.
So, at its core, GST on rent seems pretty straightforward, right? The government sees it as a supply of services, and they slap an 18% tax on it. But, and this is the big but, the real question is who actually has to pay that 18% to the government?
Well, the normal way is what's called the forward charge mechanism, or FCM. Just think of it like buying anything at a store. The shop adds the tax to your bill, you pay them, and then they handle sending that tax money to the government. Simple.
But then there's the reverse charge mechanism, RCM, and this is where things get interesting. It completely flips the script. The government says, hey, supplier, you don't have to worry about it. Instead, the responsibility gets pushed onto you, the person receiving the service. So in our case, the tenant has to do the math, calculate that 18%, and pay it straight to the government.
So let's just boil this down. Forward charge, the landlord pays the tax. Reverse charge, the tenant pays the tax. That's it. It sounds like a simple switch, but believe me, the paperwork and compliance implications are huge.
Okay, so you might be thinking, why isn't every business freaking out about this? Well, the magic answer is something called Input Tax Credit, or ITC. For most businesses that are registered for GST, it's a game changer. It basically lets you claim back the GST you paid on your business expenses, like rent, against the GST you collected from your own customers. The result? It's cash flow neutral. It's really just a paperwork exercise.
All right, you got the basics down? Good. Now let's apply all this to commercial rent, because this is where those new rule changes really start to bite.
Okay, this table breaks down the 4 main situations you'll run into, but I really want you to zero in on those 2 highlighted rows. They're the whole reason we're having this conversation. The first is when you have an unregistered landlord and a registered business as a tenant. The second is an unregistered landlord with a small business tenant. These are the 2 game-changing scenarios from those late 2024 and early 2025 updates.
So here's the absolute crux of it. Before October 2024, if your landlord wasn't registered for GST, it was simple. No tax. Happy days. But now, it doesn't matter if they're registered or not. If your company is registered, the obligation to pay that tax falls directly on you.
I know, it sounds like a pain, but it's really just a 3-step dance. Step 1, pay your landlord the normal rent, no changes there. Step 2, you calculate that 18% GST on your own and pay it straight to the tax man. And then step 3, you turn around and claim that exact same amount back as an input tax credit. So you see, for most businesses, it's a wash. It doesn't actually hit your bank account.
But the government quickly realized, whoa, this is a huge burden for the little guys. I'm talking about small businesses, especially those on what's called the composition scheme, who can't claim that ITC back. For them, it's a real cost. So they introduced a fix. As of January 2025, those specific small businesses are now exempt from this whole RCM duty.
Okay, let's switch gears to residential rentals. You'd think this part would be easy, right? Residential means no GST. Well, it's not that simple. There's a really sneaky trap here that a lot of businesses are falling into.
So the rule on the books is crystal clear. If a property is a residential dwelling and it's being used for residence, someone actually lives there as their home, it's totally exempt from GST. No tax. Sounds simple enough.
But what happens when a company rents that exact same apartment? Maybe as a guest house for visiting execs or for an employee who's relocating? That's where the twist comes in.
It all comes down to one thing, the purpose test. Let's look at this. On one hand, you have a doctor who is GST registered for their practice, renting a house for their family. That's personal use. It's a residence, so it's exempt. Now take the exact same house. A company rents it to use as a guest house. Suddenly, the end use is for business, and bam, RCM applies. The company has to pay the GST.
And this right here is a perfect example of a core principle in Indian tax law: substance over form. The tax department doesn't care what the building looks like or what the lease calls it. They care about one thing: what is it actually being used for?
Okay, let's get practical. We're in the home stretch. This is your survival guide. The key risks and the crucial steps you need to take to navigate this without getting into hot water.
Here's a big one that catches so many people out. What if your landlord is a non-resident Indian, an NRI? Well, your compliance just got a lot more complicated. Not only do you have to handle the GST side of things, but you also have to withhold a whopping 31.2% of the base rent as tax deducted at source, or TDS. That's a huge thing to miss.
And for anyone running a business in more than one state, listen up. This is critical. The GST follows the property, not your company's headquarters. This is called the place of supply rule. So let's say your head office is in Delhi, but you rent an office in Mumbai. You might actually need to get a separate GST registration in Maharashtra, just so you can claim back that ITC on your Mumbai rent. It's a logistical nightmare if you're not prepared.
So to wrap it all up and keep your business safe, here's your action checklist. These are non-negotiable. 1. Know your landlord's GST status. 2. Dig out that lease agreement and read the fine print on GST. 3. Keep detailed records on how every single rented property is being used. 4. Stay alert for more rule changes, because they will come. And 5, the most important one, if you are even slightly unsure about any of this, for goodness sake, talk to a tax expert.
So I'll just leave you with this final thought. Your lease is coming up for renewal. You might think everything's fine because it was fine last year. But with everything we've just talked about, is your lease really GST-proof for the future? Because in this new environment, just hoping for the best isn't a strategy, it's a risk.